This is our Forex blog for September 19th, 2011. And like most days, we really want to trade the strongest currencies versus the weakest. Usually over the weekend, I don't have my computer running, so this top histogram is the bar by bar real-time statistical strength of the dollar. This one is of the yen and each individual currency. Underneath that, when you bring this offer up and run it live, which I do most times during the week, but not over the weekend, it will update in real time, bar by bar, the intermediate time frame trend. Underneath that, the daily trend, weekly, and monthly. So when all the time frame trends line up, you want to buy that currency. If it's green, if it's all red, you want to sell it. Some days you have some currencies that the real time trend strength is up, but the daily, weekly, monthly is down. You can still buy that currency, but the odds of it going for the entire day is very tiny. You're probably only going to make 10 to 30 pips max, because you're getting into a counter trend trade against the longer term direction. So the euro had some counter trend strength, even though the longer term trend was down. And around 4:30, you start to see incredible weakness. Now, the dollar, unfortunately, wasn't strong then. If it was, we'd be looking to focus on buying a little bit later at 4:30 when it became strong. Actually, at 4:30 it did go strong. It was weak an hour before that. So basically, you have the euro dollar to sell, and that was really the only one that showed intensity. These tools, our currency meter, uses 5 different tools to measure both direction and intensity. There's 3 tools that measure the direction. In other words, if the euro is going down against the majority of currencies, it's going to have a strong red reading here. But 2 of them, measuring about 40% total, measure the intensity of the euro. You don't really want to trade when all currencies are underneath this 80 level. It means that they may be going down, but they're not going down with incredible intensity, and the chances of it continuing down are less. It's usually not worth your time or your money trading when all the currencies don't have 80 plus levels of strength or weakness. Avoid those currencies. So right here, the euro at 4:30 goes weak. It has incredible intensity to the downside. The dollar is strong then. All the time frames are up. It had previous strength, an hour and a half, 2-hour pullback, which typically, if a currency is strong for many, many hours and you get an hour to 3-hour pullback, then it means it has more room to go because it's, kind of reset itself in some ways. So here's the euro dollar chart, 4:30. You can see it had pulled back, has a nice little double top right here. Here's 435 bar. You go short when it breaks down, and you can see it fell from around 80 all the way down to 35. So there was many pips to be made in that trade. You wait for a counter trend trade, you might have lost 10 pips. You shorted it again here, whether you get out here with a small profit, 10, 15 pips, and shorted again and made 50 pips on the next drop. But the point is, the euro was weak, the dollar was strong. You focus on selling it. You're going to have an occasional 5 to 12 pip loss, but you're also going to have a lot of wins. And the Fibonacci profit targets are phenomenal places to get out of trades. So if you waited for this little hour and a half sideways range right here and went short, this makes an excellent profit target. One of our tools that excuse me, usually predicts a nice 30 to 50 pip reversal is our trend reversal dots. The bigger the better. This big yellow dot right here means the euro's been going down significantly for a long time, and it's usually likely to reverse. So if it went sideways right here and broke out up to the upside, you'd want to take the buy. And also, once you see these signals, usually the next wave down is the end of the move. So if you had shorted right here, realize that these fib targets down here are likely the maximum low of the day. You might want them to wait for this little mini double bottom right here, buy, and you can see it went up 50 pips. Either it bounces when you get these signals, 30 to 50 pips, or it goes one wave down probably 90% of the time, and then you get a 30 to 50 pip bounce. So you can trade these with the trend, and when you get a very clear counter trend signal like that, you want to trade the opposite direction. We don't have any significant ones in the pound. Dollar Swiss right here, you can see some major counter trend signals. And again, like I said, 80-90% of the time you get one of these huge yellow dots. It may go up one more wave, but usually not beyond the fib target right here, and 30 pip drop is the norm. So that would be a pullback to about 40. You can see this got all the way down to 30. Pulled back a little bit more than that. I don't see any other ones with the 3 and 4 hour trend reversals. The smaller hourly ones aren't as effective. It has to be the big yellow dots. Anyway, that's kind of something that we teach in our class. I just want to point it out in the Forex blog. So the yen also at 435 became extremely strong, and without any doubt whatsoever was stronger than the dollar. On top of that, previous to that, it was less weak than the much more intensely weak dollar for those bars. Anytime you see a currency that's not as weak as another one and then becomes stronger than the other one, it's pretty much a no-brainer. A trade better than the euro dollar was in fact the euro yen. So coming up to 5, this has a nice little sideways range right here, breaks down, fell about 40 pips, went sideways again, and then broke down and continued. Notice our IntelliStop trailing stop bars got you out of this trade right here pretty much near the bottom at 15. You would, if you use those as your entry and exit, you would have been short at 78, out at 15. Many of you have asked us to change the trailing stops from dots to a line, and my partner on Friday put that into the code. I just have to learn the method of having the line instead of the dots, and I plan on updating that this week, so it should be a little bit clearer on the charts where to get in and out if you're going to use the IntelliStop. The IntelliStop really is a brilliant tool because it's not just a trailing stop. It uses all of our statistical tools to measure whether the currency is strong or weak. So if it's weak, it's going to have a wide stop. As soon as that weakness goes away, it's going to tighten. And as soon as some strength comes in, it's going to tighten. And as soon as some extreme strength comes in, it's going to tighten even more. So it gives you space when the market's trending strongly so that the noise of the market doesn't whip you out of the trade. But as soon as that momentum dies, it tightens it kind of like a lasso. And most of the time on these very strong trending moves, you get out with pretty much as much profit as you could hope to make. Anytime you can make 70-80% of a move's pips, if it moves 100 pips, if you can catch 70 to 80 pips of those, you've done an excellent job. So let's look at some other trades. The CAD had some strength. Now this is kind of a trickier one because the real-time momentum for the most part was up. The weekly and monthly trend's up, and then it shows some weakness here. The daily trend had shifted down. When you leave this running in real time, you see it on a bar-by-bar basis for the daily, weekly, monthly. When you bring it up after the fact, there's no way to line it up properly on each bar. But let's say at 8 o'clock right here, the CAD daily trend shifted down. The real-time momentum was weak for an hour. The yen was, without a doubt, the strongest of all the currencies today. So you'd want to be selling the weak CAD versus the strong yen after 8. Now here's 8 o'clock. It really just began its downtrend. And you can see it fell from 78 all the way down to 77.10. Now what if you see this trade and it's already gone down a little bit? The best way to get into a trade like this is really using our range bars. Go to CAD yen, and instead of bringing up a 5-minute chart, let's say you bring up a 6 pips per bar. Put on the ticks per bar, put 6R for 6 range. This is called a range bar chart. It's going to download tick data, and it's going to give you some opportunities to catch this trend in a much easier fashion. First of all, notice as the market was going sideways all day, all these wasted bars. You have a lot fewer bars when nothing's going on, and so that when the market's really going, you have more bars than normal. Hold on one second here. So you have this beautiful little trade here. You have this nice little rectangle pattern right here, an even clearer one right here, and again another one right here. This one had no pullback. Now normally I will get into a trade here, here, and even here, but once it's gone down that far, I usually expect it not to go beyond the fib target of the next wave down, which would be right here, and it was so weak it went to the 1.618. So I wouldn't personally have taken this trade because I would have expected it with a high degree of accuracy to stall here at 23. It was so weak it went down to the whole number around 77, which acts as a major support area. Now I wouldn't advise new traders to go and do counter trend trades, but if you are, after it goes down, 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 the 1.618 fib area is usually a pretty decent place to do a counter trend trade, and usually you can pick up 20 pips. Let's look at the euro dollar and euro yen using a range chart. A lot of times you can see pullbacks on range bar charts that you can't see on regular charts. Now, in this case, there really wasn't much of a pullback. The first one, it might have been right here. You have a nice little hour or two sideways range breakout right here. Anytime it spends 2 hours at the bottom and doesn't get a nice bounce, doesn't even come close to the previous swing high, that's usually going to go down. And, again, I wouldn't have sold this one down here, but if you had a pattern like that, this one right here, soon after breaking down and not, a lot of times you have false breakouts at the bottom. It breaks out and then it comes shooting back up. Everybody who sold it has to rush in and buy to exit their trade with a loss. This one broke down and went sideways. There was some buying at the half number. Whole and half numbers frequently have, buying and selling it. You can see the whole number right here had some buying. It acted as support. Once it broke it, it's going down. The 104.50 had support, and the 104, same as the 105, had some huge buyer orders there. These are psychological numbers that, for whatever reason, people like to buy at whole and half numbers. If they have a 50 pip stop, they know where to, put their stop. Here's the euro yen, which was even weaker. Oh, actually that was the euro yen. Here's the euro dollar, which was less weak. Remember, this has to download tick data. This is what I would consider a pullback. Assuming this was in a downtrend, a nice little pullback of like 15 to 25 pips. Draw your trend lines underneath the bars low. When it breaks, you go short. You put your stop 1 to 3 pips above the swing high. Is a great place to do that. On a 5-minute chart, you wouldn't have even seen this little pullback right here. It's a place to get into the market with a defined and very logical risk. If you put your stop right above here, not only is it a pip or two above the little tiny pullback right here, it's also above where the previous swing low is. So anyone who bought here and it went up and came back down, if they still are in their position, if the market returns to that spot, there are likely to be some selling there, as people like to get out of trades at break even because of fear of the market going down again. That's just human nature, and you'll find that that pattern repeats itself way over 50% of the time. If the market's going down, you get a nice little pullback right here. A lot of times on the range bar charts, you have wicks at the high as a good reversal pattern. They work probably low over 50% of the time. When they don't work, you have a tiny, tiny less than 10 pip loss. And then when the trade works, and look, in fact, that's a trade right there that lost. If it goes sideways for a while and breaks down, you can sell it again. This looks like another reversal pattern. A lot of times I'll take trades using range charts because they're very clear. This is also an Elliott two-wave pullback. Anytime the market doesn't reverse and go down, you always want to watch the currency meter at the same time. At 7 o'clock, there's really not that much weakness in there, and the dollar is actually showing incredible weakness. So you really wouldn't have been taking those trades. You always want to have the currency meter up and watching it. We have also built this FX Trend Pro into the hot list, so you can always see the current real-time strength or weakness of each pair as a combined pair and as individual synthetic pairs. In other words, just the dollar, just the euro, and so forth. I'm going to end class today with just a kind of a review. If you have two currencies that are both weak, like the CAD and the Australian here from 8, you really don't want to trade two currencies that are weak. In other words, the Australian CAD from 8 o'clock onwards, pretty likely to be choppy. Now in this case, it went up because the CAD was weaker than the Australian. However, most of the time you get kind of something like this. It goes up, down, up, down, up, down, up, usually down again. You don't have, if you notice the distance right here, it moved 40 pips over multiple hours, whereas the euro yen, which was one of the weakest ones, over that same time frame, fell about 65, 70 pips, and it was one way. It's not choppy at all. Now, you could have also sold the weak Australian against the yen too. It's going to go down a lot and be very easy to trade. You have a nice downtrend here. Notice on the 5-minute chart, it doesn't really look that good on the pull as a pullback right here. If you bring up a range chart for this, you're probably going to spot a low risk, a defined low risk, where you can put your stop at a logical place. You have a nice little pullback right here, a couple sideways bars, you go short with your stop 1 or 2 pips above the high here. You can also spot swing levels much easier for more accurate Fibonacci areas. And so when you're short right here, your profit target's down here at 84. You're expecting to make about 30 pips if the trade works while risking less than 10. So that's a 3 times bigger win than loss. And when you are trading with those kind of simple math numbers, you don't even have to be right 40% of the time to make money.